When you're starting out, protecting your capital is the only priority. Software subscriptions can look like unnecessary leaks in the boat. But for a developing trader, the tools chosen to save money often create the largest hidden expenses in the entire workflow. This leads roughly 50% of new traders to the same default choice, a blank Excel spreadsheet. It's familiar, it's zero cost, and it feels like the smart, frugal way to begin. However, that frugality comes with a specific trade-off. You might save a $30 monthly fee, but you risk losing much more to repeated, undiagnosed trading errors that a static log simply won't catch. To see real improvement, a journal needs to function as a business intelligence tool that surfaces your weaknesses, rather than a simple history of past results. For an absolute beginner, a spreadsheet is a reasonable starting point. It's a fine place to log paper trades or track basic data points like entries, exits, and raw profit. The risk is that storing these numbers creates a sense of security that isn't always justified. A record of a loss tells you what happened, but it rarely explains the behavioral reason why it happened. Staring at a wall of cells makes it difficult to extract actionable patterns. It's hard to find your edge when you're manually digging through raw data, instead of looking at a visual dashboard that maps out your performance. You have to consider whether your current tracking method forces you to improve, or if it has just become an administrative chore. Data is only as valuable as the insights you can pull from it. If the logging format obscures your behavioral patterns, you are keeping a record of the past without a clear strategy for the future. The first hidden cost of the manual approach is the time tax. Every trade you take adds to your daily administrative workload. Logging 5 to 10 trades a day manually doesn't seem like much, but it compounds into 5 to 7 hours of purely clerical work every single month. This friction often triggers the abandonment tax. When journaling feels like a tedious task, especially after a losing day, traders are statistically more likely to stop doing it entirely. This line shows the drop-off in user engagement with manual journals. Most traders give up right between the 60 and 90-day marks, meaning the habit dies before they gather enough data to be useful. This isn't a theory. The limitations of manual spreadsheets are documented in academic research on trading systems. The findings in this study show that manual methods often fail to provide the structured insights needed to turn raw data into an actionable strategy. Modern software removes this friction by using automated API connections to pull your data from hundreds of different brokers instantly. Consistency is the goal, and friction is its biggest enemy. If the process of logging a trade is a burden, the habit will likely break. The second major blind spot comes from how you review your trades. Most spreadsheet users look at their results hours after the market has closed. Looking at a static chart at the end of the day often leads to hindsight bias. When the outcome is already known, every exit looks like it was obvious and easy to predict. But a static log deletes the context of the live market, the hesitation you felt, sudden emotional spikes, and the speed of the price action. Correcting execution errors requires seeing that real-time fluctuation again. Tick-by-tick replay recreates the market conditions and the stress of the live trade. Watching a trade unfold visually helps you determine if a premature exit was a rational risk decision or just a panic response to a normal pullback. Reviewing static numbers teaches you to analyze the past. Reviewing live motion teaches you to control your execution in the present. Finally, there is the pattern tax. This is the financial loss you incur by repeating mistakes your spreadsheet can't flag, like consistently losing money on morning breakouts or breaking your risk rules after 2 p.m. Calculating specific metrics like expectancy or R multiples for different setups is difficult to do in a basic spreadsheet with complex, fragile formulas. This is where the playbook methodology helps. By categorizing your strategies, you can visually isolate a profitable strategy from one that is slowly draining your account. Automated tagging and AI analysis then scan these playbooks to find negative habits that a human reviewer would likely overlook. Saving a small monthly fee is a poor trade-off if you end up paying a much higher price in repeated, undiagnosed trading errors. To help you decide which path fits your situation, we can use a simple evaluation framework. A free spreadsheet is a good choice if you are brand new, trading very low volume, or sticking exclusively to paper trades. You save money while you build the baseline discipline required to log data every day. But as you can see on this matrix, the needs change as you scale. If your trade volume is increasing and you need deeper behavioral insights, you have outgrown the spreadsheet. Choosing a professional journal means committing to a monthly expense, but you regain hours of administrative time and can pinpoint the flaws draining your capital. Upgrading your journal isn't about buying prestige. It's about treating your trading like a real business. A slow, manual journal can limit your growth. A professional journal takes your data and turns it into clear decisions. If you are ready to move past manual entry and start optimizing your performance, give TradeZella a try. Use the exclusive link in the description for 20% off your subscription. Your most valuable trading asset is your data. Don't leave it in a format where you can't actually use it.